Most people see a 40%, 50%, even 60% yield on an ETF and think there's no way that's real. Today, we're going straight to the source. Joining me is Mike Khouw, Chief Strategist at YieldMax. Mike has spent over 20 years in options market. He's a frequent contributor on CNBC, and he's one of the architects behind the YieldMax ETFs that have everyone talking. We're going to cut through the noise today, talk about how these funds actually work, what the risks are, and answer the big questions my audience keeps asking about NAV drops, reverse splits, and whether these yields are sustainable. Mike, welcome to Simply Money. We're excited to have you here.
Hey, thanks for having me. Really appreciate the opportunity.
Yeah, I'm looking forward to this. So if you could, before we get started into some of the questions we have, could you just tell our audience a little bit about yourself, your background, so they know who you are and what you're to the table here?
Sure. Well, I'm not sure what I bring to the table, but I'm happy to talk about my background. Longtime options guy. That's basically been the focus of my professional career since the mid-late 1990s. So in the mid-late 1990s, it would have been around 96, I started on the floor of the Philadelphia Stock Exchange as a specialist and a market maker, trading statistical volatility arbitrage using options, and for a prop trading firm that was later acquired by Knight Capital. Knight Capital became famous several years later when they blew up rather spectacularly. That was one of the larger market-making firms at the time of that. People who watch CNBC into the aughts would probably recognize their ads. They used to run ads that said where the trade gets done. Luckily for me, I didn't work for Knight Capital at the time that they blew up. By that time, I had switched to another prop trading firm called Bluefin Trading, which still exists. Bluefin Trading, for those who are familiar with the options markets, actually with the markets in general, is one of the firms that competes with big market-making firms like Susquehanna and Jane Street and Citadel, things like that. In 2000, year was it? Probably 2003, I guess. I worked for a hedge fund, a long-short equity hedge fund that's based in Los Angeles, or it was. It's now become a family office. It's not a hedge fund anymore, called Ivory Capital, which at its peak ran about $5 billion in a long-short equity deep dive fundamental approach. I'm a former partner at Cantor Fitzgerald, ran their institutional option, U.S. listed options business. And, more recently, I've joined YieldMax as the strategist for the YieldMax ETFs.
Thank you for that. We're really looking forward to hearing what you have to say and answering some of the questions. I know I get a lot on my channel. People that have a lot of the same questions, and I don't know if that's just they're not getting consistent information or they're just overwhelmed with so much information on, the YouTube, all the different videos and different sources that they may have. Let's go ahead and dive into some of the questions. For those that are new to YieldMax, can you explain in simple terms how your funds generate such high yields?
Yeah, so different funds have different distribution rates. So I want to make sure that we talk about, different terms as precisely as we can, because sometimes these things get a little bit conflated, and when you try to explain one topic, if we weren't precise in our use of it in another context, things get a little confusing. So there's about 55 funds right now that YieldMax manages in several different fund families. I actually have the YieldMax website up right now, and I think the ones that people are mostly familiar with are the single stock covered call ETFs. Examples of the single stock covered call ETFs include the largest, which is MSTY, MSTY. This is a single stock covered call ETF on MSTR, which is strategy. I wish they hadn't changed their name from MicroStrategy, because unfortunately in finance we use the term strategy a lot, and now it gets confusing when you talk about strategy, the stock, versus, say, an option strategy, an investment strategy, a risk hedging strategy. But in any case, so there are, I think, 34 of those, if memory serves. We launched some recent ones as well on Reddit, GameStop, Hims and Hers. So those are basically just long the underlying asset. And actually, it's really long a proxy for the underlying asset. Because of 1940 Investment Act rules, you can't actually use the stock in those funds. There are the fund of funds ETFs. So the fund of fund ETFs will include YMAX, YMAG, And then there's two that actually allocate amongst the covered call ETFs using Dorsey Wright. Dorsey Wright is an RIA. It's owned by NASDAQ. It uses their technical analysis techniques to allocate between them. So, I kind of think of those as a hybrid. That is to say, it's not up to the YieldMax portfolio managers exercising their discretion how it allocates within those. That's using a process by a different RIA to do that, but so there are those. We have the Ultra ETFs. One of them I know you talk about a lot is ULTY, which is the Ultra Option Income Fund. This is diversified in that it owns a number of underlying stocks. So in this case, because it is diversified, you can actually own the underlying stocks. It is looking to collect the net positive theta. That means it's supposed to be collecting options premium. But it has some other things that it can do. So, for example, it can hedge the underlying assets with the purchase of puts to mute the downside, which is not something that the covered call ETFs do. So it has a little bit more flexibility. One way I've heard Jay Pastrichelli describe ULTY, and I think this is a reasonable way to think about it, it's kind of like an actively managed, options-based, diversified strategy akin to what a hedge fund might do, but in an ETF wrapper with ETF fees. So, trades like a stock, lower fee, full transparency. These are all things, coming from also working in a hedge fund, I can say that full transparent, real-time transparency, low fees, and immediate liquidity are not things that hedge funds typically offer. But in this case, it has a slightly more nuanced option strategy that it can implement. SLTY, SLTY, has similar operational flexibility with respect to the types of strategies it can use, but the underpinning thesis is making a short delta bet. That means leaning against the constituent stocks, whereas ULTY is leaning long the constituent stocks, if that makes sense. Then we have the short options income ETFs. These are not the inverse, but they have a directionally opposing view to some of the covered call ETFs. So Winter, for example, is leaning against strategy, whereas MSTY is leaning long. Crash is leaning short Tesla, whereas Tesla is leaning long. Fiat is, as the name might imply, leaning short coin, and so on. So those are just basically similar in their overarching philosophy about collecting options premium, but leaning short the underlying assets. The target 12s, and we might want to touch on these, are the ones that are diversified, and these are in some ways less aggressive about the rate of distributions that they choose. So you have, I think, very handsome distributions in most cases, but they are distributing less of the assets of the fund for any given distribution period, and consequently they tend to exhibit sort of more stability or tracking within the net asset value of the fund. In fact, you'd actually see that if you reinvested the distributions, how closely they might track against some of the underpinning assets. Biggie, for example, is looking at the 50 largest publicly traded companies, so it tends to track the S&P a lot in that respect. And then we have some zero DTE funds and so on.
When you talk about the target 12 producing a lower yield, obviously ULTY
lower distribution.
ULTY is probably the highest you guys have currently, if I recall. Where would you
amongst
say that
the
is?
Diversified ones?
Yeah, where would you compare that as far as when you're saying distribution? What percent are you looking at on those?
Well, we can actually just take a look really quickly at Biggie. We'll start with that. This is, like I said, I'll do this first, and I know you'll be able to share my screen so people will be able to see this. I'll just show the constituent stocks that are in it and their respective weights. It's going to be stocks that are very familiar to everybody watching. Apple, Nvidia, Microsoft, Alphabet, and Amazon and Meta are the biggest constituents by weight in that fund. And in terms of returns, and I'm going to go back to inception, and for those who are not familiar, I'm going to explain what this chart is actually illustrating, because I think that might be helpful. So this only goes back to November 21st, which is the inception or the first day of trading of the fund. So as you look at this chart, just get rid of the bottom part at first here so we can kind of look at it this way. The orange line that I'm highlighting here, the orange line reflects the total return of the fund, and the white line reflects the price change of the fund, and the little blue boxes are all of the respective distributions that fund has made, right? So a simple way to think about this is if we look over here in the center where it says total return, since November 21st, the price of Biggie has gone up by a little over 5%. The total returns, had you reinvested all of the distributions that you've gotten since this started trading, and there's 1, 2, 3, 4, 5, 6, 7, 8, 9 of them, would have been 15%. The shares and just taken the cash distributions, you would have had a total return of 14%. Now, you'll notice 14%, which is just the cash distributions, for example, held at the risk-free rate, and the price change, 14% minus 5% is 9%. Each of these distributions represents about 1%, right? So every 4 weeks, there's a 1% distribution in this one. And you can see in this case, for some people, this is who don't want the higher rates of distribution in the short term, this might be favorable because you're also getting some capital appreciation and you're getting some distributions as well. And this, the total returns here are actually, we can compare this to, say, investing in SPY, right? Because SPY would have had many of the same stocks in it. And here we can see that the total returns for SPY, if you had reinvested the dividends, are actually lower. So Biggie achieved better total returns than SPY did if you reinvested the dividends than if you had reinvested in SPY. And otherwise, it had approximately the same total returns, but instead you're actually getting distributions regularly over the course of time. I think it's important for people to recognize that the way I often like to describe options strategies is it's a little bit like a balloon that you can squeeze. You know, you can squeeze it so you can try to get more capital appreciation. You can squeeze it so that you're trying to get more distributions in the short term, or you're trying to get smoother returns. You know, you can sort of think about all of the different things that different investors might want to get out of an investment portfolio. And by adjusting the strategy, you can get more of one and less of another, you know, as you see fit. But most of the funds, like ULTY, and we can look at that one too, this is one that focuses more on increasing the rate and pace of, and I'm going to use the same start date just so we're always looking like for like. So this one actually has higher total returns had you reinvested the dividends. It has lower returns if you had not reinvested the dividends over that same period than Biggie did. But that is partially a function of the somewhat higher volatility that you're going to see in this one. Now, this one is a little bit different because there was a change in late 2024 to the filing. So they were able to implement more hedging and they increased the pace of distributions to weekly. If we take a look at that and say, okay, well, how have these things done since, let's say, the end of February, once they went to weekly distributions? Is that when they went to weekly?
I think it was end of March.
I think so. End of March. Okay, so we can let's go to the end of March then. This is the performance of ULTY since March 31st, right? So we can see here, the price has declined by 9.3%. The share price has gone down by about 9.3%. The total returns, had you reinvested the dividend, would be 39.6%. And if you had not reinvested your dividends, just kept them in cash, your returns over that period of time would be about 33.65%. This is going to be interesting because we can then just put in SPY and say, okay, well, how did that do over the same period? 20% in both instances, because SPY basically doesn't pay any distributions. You don't get any, over that course of time, you'd have gotten 2 distributions and they were nominal. ULTY's total returns are almost double what the S&P returned. And that was during a period when the S&P did exceptionally well, I would say. And if we look at Biggie, my guess is, because I don't know off the top of my head, we're all looking at this together, I'm going to guess that Biggie is probably, going to be lower. And so here you can see that Biggie behaves a lot more like the S&P, which makes perfect sense. It's got the top 50 largest stocks, so its weights are going to be very similar. It has outperformed the S&P since the end of March, but it's not quite as high return basically as ULTY has generated. It's not even close, actually. It's about a 17% difference.
No, that's great. Thank you for sharing that. I love charts because, visually people sometimes they can hear the numbers. They just need to see it. And I like how you explained all the different families you have of your different ETFs and funds, because something I always say is personal finances are personal. We have some people, all they want is income. They want to maximize the income they can get. Other people want nothing but growth. And, 30 years down the road, they're just going to sell out the stocks and fund their own income that way. Then there's people that kind of want to mix and balancing that. And seems like your yield funds and your families have different options for everyone.
Objectives.
Yeah, everyone's goals are different, risk tolerances are different. But you showed the one chart there on ULTY, and it does bring up a question that a lot of viewers ask. What happens with the NAV if it drops too low? Yes, you're generating this high income, and it is a income-driven fund, but what are people to look at, short or even long-term, however long it takes, if that fund continues to drop in its NAV?
So I guess there's two things to think about, which is the total net asset value of the fund overall, and then there's the NAV per share, right? So these are two different things. Let's talk mostly about the NAV per share because I think that's what people are mostly interested in. In a circumstance where the net asset value per share gets down to, let's just say for the sake of argument, it got down to $1 a share, right? Let's say over the course of the next 6 months, we got similar total returns. The total returns were 40%. But let's also assume that of those total returns of 40%, let's say that we actually distributed a higher amount than the total returns that the fund generated over the course of that time, right? So over 6 months, it generates 40% total returns on the assets, but we distribute, some number that's bigger than that. Well, what's going to happen is that the net asset value per share will decline. And if it gets down to about $1 a share, so this is going to depend on the respective exchange, but exchanges don't want shares trading on their exchange that are in the pennies, right? And a lot of people don't necessarily want that either. So I think you brought this up, and I guess we can kind of get to that. In that case, assuming that the fund itself is still exhibiting very attractive rates of return and that there continues to be significant interest in it, then and only then might you begin to consider doing a reverse split if it's essentially forced upon you. You would do that. But that doesn't have a huge impact other than changing the amount of shares outstanding. It doesn't change anything with respect to the operation of the fund itself because the PMs and the traders, they have no visibility on that. They don't think about the pool of assets on a per share basis. If you're running $1 billion, you run the $1 billion according to the strategy to get the best total returns that you can. So that's their objective as traders and fund managers. And that won't change. And the number of shares that pool of assets is divided into won't make any difference to them. In terms of the payout rates, it still won't make any difference either because whatever the payout percentage rate is that is determined by both the system, because most of these things are formulaic with some human oversight. So Jay Pastricelli may, make some minor adjustments based on what they know is sort of going on underneath it all to kind of smooth things out a little bit. And some of that might be, potentially tax related. It's not really going to have that much of an impact. You can imagine this, that if this fund continued to have returns like this, right? So 40% over the course of how many trading days is this? Let's see if I can highlight this. It's not going to show me. But from the end of March to the end of September, that's a 6-month stretch. 40% total returns in round numbers, which is I think any fund manager would be very happy if you could continue to generate returns like that. If we continue to generate returns like that, I expect that the pool of assets that the fund is managing is just simply going to increase. And people probably shouldn't be focusing too much time and attention thinking about the actual share price. Focus on your total returns. How much money am I making from my investment? That's the important part. But it does influence how people think about it because look at it this way. I'm going to just pull up a chart of the stock price over the exact same period. And when people look at this, if you go on to Yahoo Finance, for example, and you're just looking at the price chart and you say, well, that doesn't look so great. The price is going down. Yeah, the price of the shares is going down, but the total returns are over this same period are significantly positive. And why is that? It's because you're receiving distributions from it. And those distributions are as follows. We can see all of these distributions here. So if we go back to March 31st, so that was the 26th. So really what you're looking at is all the distributions from April onwards. If you own the shares, these are all the distributions that you're receiving. Now, you can choose to reinvest some of those distributions if you choose, or not. If you choose not to, that's going to impact how much money you still have in the fund because you're going to be receiving some of these distributions out. Some of it is going to be coming from options premium. Some of it might be just some decay in the NAV amount because you're basically having some of your own money handed back to you at that point. But the total returns are still quite exceptional. I mean, everybody would be very happy to be getting, I think, 40% total returns over the course of 6 months. I'm not saying that that's sustainable forever. I mean, there's obviously some pretty good things that the team was able to take advantage of to get returns like that.
Can we put that in money terms instead of percentage? I'm sitting here thinking, okay, let's say we'll just use easy numbers that say ULTY's price does get down to $1 and you do a reverse split. Let's say I own 1,000 shares and your reverse split. Now I have 250 shares. And for simple math's sake, let's just say that the distribution was 10 cents. Does that mean my distribution now goes down to 2 cents and a half?
No, it goes the other way because the distribution is a percentage of your assets. So let's think about it this way. And actually what I'm going to do here is I'm just going to call all the dividends for this one so we can kind of use a simple example and then figure out. Let's look at this list of distributions and say, okay, well, what would have happened if there were different share counts to you as an investor when those distributions took place? Does that make some sense?
No, perfect.
I have an API in Bloomberg that I can call on so I can just get the dividend history from that. So I'm just going to get all of the dividend history for ULTY. And in addition, I'm now just going to turn this into just raw data because you can't manipulate an array when you are calling on an API to feed it. And most people like to look at time going the other direction. You just want to know how much was the dividend, how much was the share price. So now the other thing I'm going to do is I'm going to take the price of the shares at the time that the dividend was declared. So we know essentially what the percentage was at that time, if that makes sense. So you know what the distribution, effectively what the rate was in percentage terms, because I think this will help illustrate what I'm talking about. Okay. So these are all the most recent distributions. Remember that since it became a weekly pair, that was, as you point, actually, look, I see weekly distributions in March.
Oh, okay. I thought it was the end of March.
Actually,
so it's February?
No, it looks like it was the end of, so March 5th, then the 12th. So those are weeklies right there.
Okay, nice.
Okay. So this was basically when the weekly paying got started right in here. So we'll put that into blue so we get a sense of it. All right. And now I'm just going to calculate the percentage of the pre-distribution share price that each of these represented. That's how much the share price was before the declaration, and this is how big the distribution was in percentage terms. The way this would work is let's say we had done a reverse split beforehand. You said you had 1,000 shares, let's say. So you had 1,000, we'll say you had 1,000 shares, and let's say we did a 4-for-1 split or a 1-for-4 reverse split, right? So you had 4 shares, now you get 1. What's going to happen is the share price is going to be multiplied by 4. The number of shares you have is going to be divided by 4. And the distribution that you get, that percentage will remain the same, but the distribution per share will be multiplied by 4. Effectively, then the percentage value would remain the same. So we already know what the price per share is if at the current price, but if you had that 1-for-4 reverse split, this would be the price of the shares in that instance. And 4 times this amount would be the distribution that comes out each time instance. And then the percentage is still going to be the same because when you're thinking about it this way, how many slices are you dividing the pizza into? If you have 12 slices in a pizza and you own half the pizza, if I reduce it into 2 slices, you're only going to have 1 slice now, but you still get the same percentage pizza, if that makes sense.
No, because people hear yield and percentage, and sometimes that just doesn't register. With reverse split, I think a lot of the viewers really feel like they're thinking about a dying stock and how those sometimes reverse split become penny stocks. And you see that a lot in that field where with these ETFs and these funds, price dropping low isn't because the underlying value is gone. It's just because of how it's been distributed. Am I correct in saying that?
That's a good way to think about it. I mean, here's one way to think about what will happen to the NAV in certain circumstances. And where this really gets a little bit confusing for people is in the concept of return of capital. Because return of capital, when you look at the 19A-1 filings, the notices that come out when the distributions take place, is an estimate based on a characterization of a distribution based on tax. This is something that I think when I explain it to folks, I realize it doesn't seem super intuitive, but I think maybe a simple way to think about this is let's just think about, we're going to just start with a clean slate here and kind of work through a theoretical exercise. And let's just assume, for the sake of argument, that we have some stock that costs $100. And I'm going to use the simple example of a covered call in my example. So I start with $100, and of course the truth is that if you're doing covered calls, you actually have to usually own 100 shares of the stock, so that'd be 10,000. But I like to think about things in terms of $100 because it makes it really easy to convert back and forth between percentages and stuff like that. Let's imagine that you have the stock at $100 at T1, and you sell we'll say you sell the at the money call, the 100 strike call, you sell that for, we'll call it $1. It expires in 1 week. So at this point, this is the stock price here, and this is the amount that I collected for my covered call. So this is the covered call premium. Let's advance the clock by 1 week. Now, in 1 week, let's say that the stock has now gone to $102. So I'm just going to write that down so that people who are following along. So this is now the stock price 1 week later. What's going to happen at this point? Well, at this point, my covered call has expired, or it's about to, and I'm probably going to have to roll it. Now, at this point, that covered call, I actually have to buy it back for $2 because it's $2 in the money. So now I have to pay $2 away for that. I have a realized loss of $2 because I sold a call for $1, but I had to pay $2 to get it back. So I have a realized loss of $1, the difference between where I sold the call and what I had to pay to get it back. But what is the net asset value that I have on a per share basis? Well, I actually made my 1% in a week, right? Because the value of the stock I hold went up from 100 to 102. The value of the call I sold, I lost $1 on that. But net, I'm up money. But if I don't do anything with the stock, if I continue to hold the stock, I have an unrealized gain of $2, right? Because I bought the stock for 100, now it's 102. But I have a realized loss of $1 because I sold the call at 1 and I bought it back at 2. So from an accounting perspective, I have a $2 unrealized gain and I have a $1 realized loss and I have a 1% return week over week. What happens if I distribute $1? How does that get characterized when we distribute? Well, you cannot characterize an unrealized gain as a capital gain when you distribute it or as income when you distribute it. That's how, in other words, the rules basically say you can't hand money back to somebody if you haven't realized those gains and call it a gain or call it income. Because I have a realized loss and unrealized gain, if I hand you $1 back, that's actually called a return of capital. Is it a return of capital? Well, no, because at this point, the net asset value in my fund is $101, right? Because I have $2 of gains unrealized in the stock. I have $1 of realized loss in the option. So my new NAV before I make a distribution, so this is NAV on week 2, is 101. If I distribute the $1, that $1 is going to come back to the investor as return of capital, which seems strange. Thinking to yourself, why would that happen? Why do they call it that? It's not up to us. That's just how you cannot make a distribution of an unrealized gain and call it either a capital gain or income. But let's use a different example and say I didn't distribute $1. Let's say instead I distributed $2. If I distribute $2, and actually this realized loss, because that should be 1, because that's my realized loss. My realized loss is $1 because I sold the call and bought it back, paid $2 to get it back. So that's the amount of I realize if someone's looking at this at home, they're going to be a little bit confused by that. I paid $2 to get it back, but the realized loss is the difference between where I sold it and where I bought it. If I distribute more than $1 in week 2, then let's say I distribute 2. Well, then the net asset value per share after I make that distribution, if I distribute 2, would be 99. Does that make sense, right? So I've got a net asset value per share of 101. If I distribute 2 back to the shareholder, the new net asset value after the distribution is now going to be $99. I assume that's pretty clear. What we have then is we have a 1% real total rate of return over the course of 1 week. We had a decline in the net asset value per share of $1, and we had a distribution of $2 in that second example. And this is I think where people get a little bit lost, and the other place that people sometimes get lost is that what would have happened if the stock price declined? Let's say that the stock price on the second week was now $98. So it lost, the underpinning shares lost 2. And now what has happened? And I still distribute the buck. In this case, the net asset value of the entire fund on a per share basis has declined by $1. Why is that? Because I have an unrealized loss of 2. The underpinning shares were 100. Now they're 90. And I have a realized gain of 1 because I sold the call premium for $1 and now it's worthless. Now, if I distribute that 1, the new net asset value is going to be the $99 less the 1. It's going to be $98. I'm going to distribute $1 of income because it was a realized gain. The net asset value is now going to be down by $2, reflective of how much the stock declined. And my total return is negative 1%. And I realize there's a lot of numbers getting thrown around here, and people are like, okay, net asset value per share, income, return of capital. So in one case, the value of the assets rose, but you had an unrealized gain, and you had a distribution that got characterized as return of capital. And in my other example, which is not the happy circumstance, the underpinning assets actually declined in value, and I received a distribution, but it was characterized as income. And this is, I have seen professionals get lost with this. There are analysts who are evaluating these things that are saying, oh, they said return of capital. They're just giving you your own money back to you. Well, no, because if the perfect example of this would be, if you gave me $100, I buy $100 worth of the stock and I double the assets over the course of time. But every time I'm making a distribution, I have these unrealized gains against realized losses, all the money coming back. I could have doubled the assets and I could have given 100% back as a return of capital over the period. You gave me 100, you got 100 back, and there's still 100 in the fund. So how does that happen? And it's because there was an unrealized gain, and you cannot characterize that as income when you pay it. Ultimately, of course, everything gets trued up. The IRS is always going to take their pound of flesh. If you sold those shares at that point, you said, you know what? I'm happy with this. I gave them 100. I got $100 back, all return of capital, didn't pay taxes on that. Now I'm just going to sell my shares and get that other 100. Now I've doubled my money. Well, don't think that that's going to come to you tax-free. Why? Because every single time distribution that's characterized as a return of capital, it lowers your basis. So even though you paid $100 for the shares, when you got $100 back as return of capital, your basis went to 0. You sell the shares, you now have a capital gain. The difference between the $100 that the shares are worth now and the 0 that is your new basis. And your basis can never go negative. That's something else. There's no magic genie that says, oh, I'll put money in and I'll keep taking money out and it'll be tax-free. Unfortunately, we'd all be rich men if we could figure out how to give people distributions without any tax consequences. Unfortunately, that's not how it works.
No, not for us anyways. That's a great explanation, Mike. I appreciate the in-depth coverage of that because that is probably the biggest question I have on the channel is people are so afraid of the underlying value dropping and feeling like they're losing their money, their investment. I know MSTY has been one that has seen quite a bit of a drop in that over the course of time. I think it's down now around $12. But people, we should take a quick look at this because let's do that.
This actually gets to the heart of another really important point. And since we were looking at it from March on, I think this is a decent time to look at it. So the total returns for MSTY over the last 6 months. So basically from the end of March, I should want to make it an even 6 months. So just from end of March to the end of September. So the total returns for MSTY, if you had taken the distributions and reinvested them into MSTY, would have been 12.55%. If you had invested in MSTY, just took the distributions and left them in a money market account, your total returns would have been 16.9%. And the price change for MSTY over that same period of time is the share price has actually gone down 31.3%. So if you'd bought it at the end of March and just taken the distributions, you'd have made almost 17% over 6 months. If you had reinvested in the securities, you'd have made less, 12.5%, and the share price is down. So you're asking yourself, well, how come if I reinvested my dividends, my returns are lower than if I had just kept the distributions in cash? And the answer is, and this is important for anybody looking at a covered call, You always care about the price of the underlying asset. And the answer is when we look at Strategy's performance itself. Anybody who's been paying attention, and I'm sure a lot of people are, have recognized that MicroStrategy of late, particularly since July. So if you'd been covered call and you were reinvesting, especially in this late period, Strategy's been going down. See that? You can see that, MicroStrategy and MSTY with its distributions, oops, where did I put that? So distributions, almost 17% in MSTY if you had just put them into cash. Here it's close to 22%, but all of that is because of the gains over here. It's been declining since. Strategy has typically been, in fact, actually, we should probably look at it to really emphasize this point. If you're in a covered call, you really care about how the underlying is doing. So let's take a look here. So it looks like the all-time high was on July 16th. Let's put that in as a date. So Strategy has fallen 22.9%. Now you'll notice that the total return, the price change, and the dividends reinvested are all the same number when you look at Strategy. Why? Because it doesn't pay any distributions at all, right? So they all have to tie out to the same number. If we look at MSTY over that same period of time, so that was July 16th, 2025, it's going to have a very similar circumstance. So basically what's going on is the share price is declining, and you are going to lose because that is the underlying asset that you own. That's a tough situation. If you are looking at covered calls, you care a lot about how the underlying asset is performing. ULTY is a little bit of a different animal because ULTY has a lot of different underpinning stocks in it. That's the first thing.
Yeah, can you explain with ULTY for those that how they're rotating those out and the different ones they're using there? That'd be great.
Yeah, sure. So all of these funds, as everybody who's watching is probably aware, you can see overnight transparency. So they publish all of the trades that are being done in these funds, and they publish the holdings of the funds overnight. And this isn't just true for YieldMax ETFs. Most ETFs are what we call fully transparent. Fully transparent funds do exactly that. The custodian publishes the holdings that are within the fund overnight, the custodian being the custodian bank where the assets are actually held. So when people invest in these things, it's not like the assets are being given to us. They are held in a custodian bank, and then we manage those assets. So I think that's an important thing too, because I sometimes get the feeling that people think like there's some account that is YieldMax's account where these assets are held, and that's not really. We're managers of the assets, but we're not the custodians of the assets. The U.S. Bank, I think, is the custodian in this case. We use U.S. Bank mostly, and then I think we have State Street is being used for some other funds. But this portfolio, in general, one of the things you're going to see, there's some crossover with some of the single stock covered call ETFs. And the reason for this is that most of these stocks are going to have a couple characteristics. They're going to have relatively high implied volatility because we're looking to generate options premiums. On balance, we're expecting to be net short options premium, and that's part of how these funds generate their total returns. You'll notice that the characteristics of the stocks that are held in these funds they're probably going to have betas higher than 1. You're not going to see a lot of Procter & Gamble, Johnson & Johnson, things like that in these funds because they just don't have a lot of options premium. So that's the first thing. The second thing is you're going to recognize all these names. They're typically going to be pretty big because this fund has over $3 billion in it. Even though we're breaking it up, the largest one here is Robinhood. You can see 6.4, almost 6.4% of the fund. But that's a lot of stock, right? So it's almost 1.5 million shares of a stock that, as of today, is Hood's share price. We'll call it $150 a share, right? So, and I'm just using round numbers. So, $150 a share, 1.5 million shares, it's $220 million worth of stock. So you can't do this in rinky-dink little stocks, if that makes any sense. The other thing is that the managers and the traders are looking at stocks where they're generally going to be taking a bullish perspective. So is the momentum working their way on those stocks? Is it a good technical setup? Do they believe in these companies? And that is going to go into this. But the first and foremost thing is that they have to have liquidity. They have to have volatility that's worthy. Now, the nice thing about a fund of funds is that you can potentially put positions into something like mine immersion. You might see that down here. we've had a lot of people ask us like, oh, are you guys going to do a Bitcoin emerging covered call strategy because I'm interested in just holding that. Sometimes you're dealing with companies that we can put them into a fund as a constituent of it, but having a whole ETF that's dedicated to a covered call on that, maybe it's not quite big enough. And that might be an example of that. So you'll find constituents of a product like this that exhibit a lot of favorable characteristics, but maybe they don't quite meet the standard of having a large enough market capitalization, a significant enough options volume and liquidity to issue a single stock covered call ETF on it, even though there may be, demonstrable demand for it. And there is, we get those kinds of inquiries not infrequently. Hey, could you do one on this? Can you do one on that? Because that's what they want to have in their portfolio. But we can put some of those things into ULTY because they exhibit those favorable characteristics, but we can't maybe do a covered call on them just yet.
No, that's great. I love that explanation too. And what you said about the implied volatility is important, obviously. I think a lot of people that I've had comments from think that's the only thing that they look for is the IV. And, it makes me think of that they're obviously looking for companies that have great value and opportunity as well, not just that they're volatile, but that they have a good future. And then,
well, that's right, because, to put things in perspective, SLTY, which tends to take a directional view the other way. Now, it's going to look a little bit different because there's not necessarily going to be short stock positions, but you're going to have short-ish positions. We have some short stock in here. If you look at these, it's going to be, it's a different set of stocks, right? There isn't crossover. So it's not as simple as just saying, oh, high vol, therefore it's an ULTY. Because if that was the case, then ULTY and SLTY would have the same constituents in them, but they don't. I think that's also important. Now, granted, SLTY is also slightly smaller now, which there are benefits that come with scale, and there are benefits that come with being small. The nice thing about being small is that, you can be extremely nimble and, you can trade tiny amounts of contracts and fly completely under the radar.
right.
I guess that's a benefit that retail investors have, when for something like ULTY, it's going to be high vol, highly liquid names. And look, we have to think of these as being decent quality stocks as well. They have to have all of those.
Now, do you feel like with the popularity of ULTY, because you have to have funds that are able to handle the volume, makes me think of Warren Buffett and Berkshire. He said one of his issues is he's got so much cash to deploy, he can't just go and pick up some little mom and pop stock. He's got to have a stock that can handle the volume that he wants. Would too much assets under management in ULTY hinder the ability to be as nimble as you need, or does it have the ability to find other high IV stocks that also have upsides?
You can also expand the size of the portfolio in terms of the number of constituents that are. But I will say that there isn't too much of a functional limit when you look at the largest companies. To illustrate that, consider how much options the largest companies trade. I mean, you're going to look at this list and you're going to say, well, there are some very liquid stocks, some very big names that trade huge amounts of options and have relatively high implied volatility that don't happen to be on this list right now. I mean, what are the most obvious ones when you look at the biggest constituents? There are some of those are in Biggie that aren't in this. NVIDIA's not on that list, right? I don't see Tesla in here. I don't see Broadcom in here. I mean, there is a lot of names to trade that have a lot of liquidity and have pretty good implied volatilities as well that they haven't even touched on. And I just mentioned three of the largest, most active single stock options in the world by a huge margin. NVIDIA and Tesla both trade considerably more than Robinhood does. They are bigger companies and they trade much more options. So liquidity is not a concern for this one yet. It would have to be a lot bigger. I mean, NVIDIA alone's a $4 trillion company. Because we're focusing on the larger, these are really mega cap companies for the most part. $3.3 billion, which is what we have in this fund. I know it sounds like a lot of money, and to all of us as individuals, it is. But in the context of options and the stock market, it's actually not very big at all. I hope we get Warren Buffett's problem, right? Because Warren Buffett's got $1 trillion worth of assets.
Yeah.
$1 trillion. That's a lot more than 3.3 billion.
Yeah, a few dollars more. To respect
bucks.
your time, I want to go ahead and just ask a couple quick closing questions, kind of wrap it up. But before I do that, is there anything else that you'd like to share to clarify, maybe anything you've thought of what we've shared thus far?
I mean, this is the thing that I really want people to, to think about this as they look through it. So the first thing is with respect to the return of capital question, because I know that comes up a ton. The return of capital when the distributions get made is a characterization of that distribution, which is ultimately going to be determined at the end of the year. That's more of a tax question. So put return of capital as a tax question in one bucket, then think of return of capital as a percentage of the net asset value change in a separate bucket. So this is thinking about returns without thinking about taxes. And every investor should think about this, which is that if you see that the net asset value of a fund, if you like everything that's in it, and you see that the value on, let's say for simplicity, it's $10 a share, and you see that over the course of a period when you're another distribution, the net asset value per share has gone from, call it $10 a share up to $10.50 a share, right? So that's an increase of 5%. And you get a distribution that is, call it 2%. Well, what is that the underpinning value of the assets that your share represents has increased by more than the distribution. If, on the other hand, the net asset value doesn't change at all, let's say you started at 10 and it ends at 10, and you still get a distribution of, say, 20 cents per share or 2% of the assets, that effectively is decreasing your net asset value. That essentially is, that is what we truly would think about as a return of capital, right? So when you're following this, just recognize that the value of the underpinning assets rise and fall. And when you're thinking about your dividend reinvestment or your distribution reinvestment, you might want to say, well, if I want a stable base of assets in circumstances where the prices of the underlying assets have declined, maybe you want to have a bigger percentage of them. So I think Coney was arguably the best example of this, where I thought it was a very good example because Coinbase, this is the covered call on Coinbase. Coinbase had a period at the beginning of this year where it wasn't doing particularly well, see? So if you're looking at this chart, you can see that it fell. Now, if you had the Coney ETF and you got a distribution as it fell, maybe you want to reinvest that because you're saying, I think Coinbase could recover. So instead of spending my distributions on something else, I'm just going to reinvest them, plow them back in. And that wouldn't have been a bad thing to do because, of course, assets underpinning these strategies have their own volatility. And there are times when, do you really want to sell the underpinning asset when the price declines? It depends a little bit on your point of view. If you think the price is going down because it has significant problems, then maybe you don't want to reinvest in it. But if you think the price is going down because markets do that, markets fluctuate, and you truly believe in the underpinning asset, then maybe you do want to invest more of your distributions at that time than at times when the price has appreciated. And Coney has had very good total returns. And actually, I noticed this, by the way. So for those playing along at home, one of the things I observed was that in April, this is when Coinbase had really fallen, right? So between the beginning of the year and April, Coinbase had fallen pretty precipitously. And I was looking at the fund flows into Coney, and we had big inflows in April. And what does that tell you? Well, it tells you that investors were looking at this and they're saying, you know what? Coinbase is oversold. I want to be in it. And they deployed assets despite the fact that Coinbase had declined, despite the fact that Coney had declined. And those people will ultimately prove to be very well rewarded because what you're going to see is that it really recovered since. I mean, the total returns, if you'd reinvested the dividend since then, since the 1st of April, 57.5%. It's important for people to think about their view on the underpinning asset. That's maybe arguably it's the most important thing. How do you feel about the underpinning assets in the covered call ones in particular? If you like the underpinning stock, think about whether you would be taking money out of it or putting money back into it at that moment. Now, I want to make amply clear that sometimes stocks go down for really good reasons, and they're going to keep going down. We're in one of them. We have a covered call fund in one of them, Moderna. I mean, everybody knows that the vaccine makers, they had this huge run that they got into because of the pandemic. And then as people became less enamored of vaccines, became more concerned about whether there were side effects to them that they didn't previously realize, and the efficacy of those vaccines was viewed to be less than initially advertised, let's say, the bloom was off the rose. Now, in a strategy like this, whether you own the stock or you have a covered call on the stock, the covered call from the peak to the trough did better than this, but it didn't do well because the underlying asset fell. And that's the other thing, right? So if you're going to do covered calls, like the stock you're in. Secondly, if you're going to reinvest the distributions, pay attention to whether you still like it or not. Because if you do still like it and the price has declined, you don't want to stop reinvesting at that point because you're essentially dollar cost averaging in. You're getting more shares at lower prices. And that's true whether you just own the stock. It's true if you're in a covered call. A lot of the overarching sort of investment philosophy that I think will treat investors well if they kind of adhere to that and maintain some discipline will benefit them whether they're investing in these strategies or any other.
Thanks, Mike. That actually answered the question I was going to ask you too about what the biggest mistakes retail investors typically make. And I think that would be one of them is they don't see the underlying asset and they just see the price dropping and panic. Panic selling, whether it's in options or just holding a straight up stock. People panic. We love when the news is all green. The bull markets, we get all excited. We're buying on the uprise. And then as soon as it starts dropping, we freak out. We want to sell and we're locking in all those losses. And like you said, unless it's an actual issue with the underlying company, it's just the ebb and flow of the beast. The market does
diversify that. Also. I mean, I think diversification is very powerful. I have seen academic studies that suggest that by the time you've diversified your assets into about 10 different securities, you've achieved about 80% of the benefits of diversification that you can find. Now, that's assuming there is actually real diversification. If I buy BP, British Petroleum, and I buy Exxon Mobil, am I really diversifying myself by buying those two things? Probably not, but diversification is important. Dollar cost averaging is important, and pay very close attention to total returns, not just the distribution rates. So a distribution rate may exceed the total return, but if the total return is good, the investment is probably pretty good. And if the distribution exceeds the total return, maybe you take the excess and put that back in. That will maintain the stability of the net investment that you have. So if I have over a period, I take 50% in distributions, the total return was 35%. If I've reinvested 15%, the value of my shares should be about the same. And understand that when the manager is distributing back to you, oftentimes that's sort of a systematic thing. So they might want to have more flexibility with how much they're giving you and more flexibility with how they characterize it. But some of those things are, they're controlled by law, like how you define return of capital over a tax period. That's not up to us. That's up to the IRS.
Thank you, Mike. I'm just going to kind of close us here. Thank you so much for joining me. I know our viewers will appreciate the wealth of knowledge that you've just provided. We'll get this put out for them ASAP. And if you guys have more questions, you can just let me know down below. I will do my best to answer those. Mike, it's been a pleasure to meet you, and I look forward to seeing what YieldMax is going to be doing in the future.
Yeah, no, I really appreciate you having me, and happy to come back and talk to your audience at any time.
Sounds good. Thank you, Mike.